Yeah, looking forward to our session this morning. If you're up in Brizzy, I think the southern states might be an hour ahead. Um, Confirm that. Yes, right. You've just ticked over midday in Sydney or New South Wales and Victoria. Um, we're going to get started for the SMSF Millionaire workshop. What I might ask if you have the appropriate setup is pop your cameras on, and that way it feels more like a workshop than me just talking to a screen. Hey, Michelle, good to see you. Cool. Hey, Dan, I think we're talking this afternoon from, yeah, cool. G'day, Cliff. Thanks for joining. Yeah, much prefer seeing people and having the interaction on our workshops. And the other thing is the way I present, which might already be apparent, the slides appear on the side here. And so some of the slides, especially early in the presentation, are a little bit tricky to see. They're like tables from the ATO. So it's better if Zoom is full screen, and then also have the chat box handy. But because we are on a Zoom meeting instead of a Zoom webinar, you can take yourself off mute and we can have a conversation or a question asked verbally. So always keep that in mind as well. Just a brief introduction to Inspire. So we're an accounting firm based in the Fortitude Valley in Brisbane, and we work with small business owners all around Australia. One of our focuses, or one of our big things, is on saving our clients tax, and we calculate it, and our tally has got up to over 39 million bucks and counting. And we're about to come into our tax planning season, which that's when our calculator really starts um, heading north. Usually it's a few $1 million a year or more in tax savings for our clients. Also, I published a book, must be coming up to 2 years now, November 2023, which is called It's All Sorted. And it's a 9-step guide to master your tax and achieve peace of mind. So that's a lot on like tax for business owners, the structures behind it. But the one I do want to mention, okay, maybe a quick introduction to me. So yeah, I started Inspire when I was 23. I'm an award-winning chartered accountant with over 18 years experience, and the author of 2 books. The second book is what I was going to mention next. And oh, no, it's my family. So that's a family of my photo of my family a couple of weekends ago at my son's 4th birthday with his Batman cake and his Spider-Man cake. But yeah, a bit of a reason why I do what I do. Um, and in terms of, anyway, I think this is the slide is coming up on the book that is more relevant to SMSFs. But just to give a bit of background to why we're sharing, we love SMSFs. There's almost like one set up for our client base every week. Someone set one up yesterday. But I've been a personal SMSF member since 2011. Sort of in my early days getting into accounting, but I've also looked after hundreds of SMSFs over my career, including auditing funds. I remember one of the jobs they got I don't think this is a good thing, but the really inexperienced new people to do back at KPMG was audit the funds. And it was basically like walking to the other side of the floor, picking up some files and then checking that numbers match. So yeah, so that's how I started getting my hands dirty with SMSFs. But over the years, it's definitely become more and more, do a bit more than check that the numbers balance. We're advising clients on, how to do property transactions or even businesses inside super, which we can get into as we go. And it says that about 60% of Inspire's SMSF clients hold some sort of property. That's a big reason why people generally consider SMSFs. The other 40% might be around flexibility that they give, or some other investment other than property, such as crypto or precious metals that we have our clients invest in with SMSFs. And then I think the number's about 40%. So about 40% of our business clients have an SMSF. So it's not the majority, but it definitely is a surprising amount compared to what I thought might only be like 10 or 15%. So they are quite popular amongst business owners. I'm an advisor on many transactions involving SMSFs. 28. Sorry, the number was 38 actually, but I rounded it up to 40. So yeah, we might need to up that slide for next time for these rules. Um, yeah, and then SMSFs. So the ATO release data around SMSFs. Now, it's actually hard to find up to date stuff. So some of these, I mean, this slide here is June 23, but there's some stuff that is only as recent as 2021, which I mean, there's lots of things that have happened between now and then. But anyway, so what we're looking at here is the number of establishments, so people setting up super funds, the wind ups, so people closing them, and then we've got a figure of net establishments. So if we have a look, like just in the 2023 year, we had a net amount of 14,000, which is about 40 SMSFs a day net of the ones that are closing, adding into what Australians are doing with their super. So again, it's a pretty surprising, popular thing when it comes to sorting out super. This is one of the ones that goes back to 2021, but the average assets per member average is 790K. That's per member back in 2021. But the average assets per SMSF is 1.472 mil. Now, imagine those figures are much higher given how markets have moved and property has increased over those years. But what this sort of signals to me is that a couple of things. The first one is the majority of SMSFs have two members. So I'm guessing most of them are spouses. That's what our client base would represent. But the other thing is most SMSFs have more than $1 million in, or in terms of the average size, more than $1 million. And I think that down here, so if we look at, this is again figures from June 2021, I incorrectly said most SMSFs have more than $1 million. That's the average figure that is over $1 million in that previous slide. But 40% of funds, if we tally up those hard to see numbers, and it's hard to see because I don't have my own Zoom full screen. Yeah, you can just make out the figures there. When you add all those up, the funds where their balance or their SMSF is above $1 million is about 40% of total funds in Australia. So yeah, again, it's in terms of the idea of being an SMSF millionaire, the stats show that again we're approaching about half the SMSFs actually have $1 million or more in their kitty. Alrighty. Cool. And then yeah, in terms of resources. So I'm going to be talking a lot about SMSFs, obviously, in this workshop today, but I have written a book called Wealth for Life, where there's a whole chapter on SMSFs. In fact, it goes into detail on other things such as estate planning that also very much interrelate to SMSFs. So if you did want a copy of that one, the QR code is on the screen, although the easy way is probably instead of getting your phone, Tay has just popped the link for that book in the chat box if you do want a copy. Now, what I'm going to cover first is the 8 benefits of an SMSF. I'll run through the 8 and then I'll attack each of those 8 in a bit more detail. But the 8 benefits, the first one's engagement, engaging with your super, the idea of being a family fund, having huge control over tax when it comes to your super, and even how that plays out in generally in your wealth creation for your family group, investment strategy, the ability to loan money or leverage other people's money, how insurances play into SMSFs, that's sort of life and TPD insurances, incapacity planning, and also estate planning. So they're the sort of 8 things we're going to have a look at first off. But in terms of engagement, yeah, a couple of sort of hypothetical questions to ask yourself. Can you answer these questions? So how much do you or you and your spouse have in super? And I'm, like if I asked clients with SMSFs, they probably couldn't tell me to the cent, but we could go and find that amount pretty quickly. And I reckon most clients with an SMSF would have a ballpark of of how much they've got in super. But what I find interesting is that there are a lot of people who just have no idea how much, or their ballpark might be to the nearest 100 grand, maybe. Do you know which fund it's in? Could you, is it Q Super? Is it, I don't know, Australian Super? If you don't have an SMSF, some people have multiple super funds, which can be pretty inefficient from a fee perspective, if there's no strong reason to have more than one. Um, is the fund making a return you're happy with? Do you know what it's invested in? There's a few different questions around engagement that, that I think are pretty worthy of asking. But yeah, self-managing your own super should give you a much stronger connection with your super and overall wealth creation journey. Now, it's called self-managed super fund, and quite literally, it does take an element of managing. As the trustees of the fund, you've got to make decisions around what you invest in, how much. You've got to consider diversification as well. There's energy that goes into managing these things, but again, the payoff can be quite considerable if it aligns with your overall strategy for growing your wealth. Also, another question that pops up where people are considering SMSFs is, how much do I need in super? Now, if you Googled that question, the answers that pop up pretty regularly are 200 to 250 grand. And the basis that those figures are given is generally back to the fees that you get charged. So often industry super funds will charge you a percent of your balance. So the bigger your balance, the more fees you pay as a dollar figure. But with SMSFs, generally accountants prepare the compliance and administration, and it's usually for a relatively fixed cost. We've got a price for an accumulation fund where the clients are building their wealth over their life, and then we've got a price for pensions funds because they're a little bit trickier than accumulation. But they're relatively fixed, and it depends on what the client's invested into. For certain weirder assets, we charge a little bit more to manage them. To do the administration and compliance part of that. But relatively, it's fixed. If a client's got 1.5 mil or 1 million super, our fees aren't going to be a percent different. It's relatively fixed. And so my answer to this question is yes, 2 to 250K might be a bit of a guideline, but it depends on what you want to do with it. Because I've got a client who's up the sunny coast. They're a professional services firm. They've got, I think they started their fund with about 100K in their fund because they wanted to buy their $200,000 office space up the Sunshine Coast. So they were able to loan money from the bank, but they only had 100K or so to start with. But they wanted to secure their long-term, office space. So, and start paying rent to themselves. So again, and then we've got clients where, they want to invest in precious metals or Bitcoin directly. That they might not have that 200K, but it's the asset class they want to get their hands on. And they're okay in the short term of their, the balance not being hundreds of thousands of dollars, for example. So yeah, again, I think it's very much dependent on what your overall strategy is with the super fund. But without having a, what's the word? In the absence of having a strategy, the guideline is about 2 to 250K. And that goes for, sorry, I might just mention, that goes for the fund in total, because let's say you've got you with 100 grand and your spouse has 150K. It's actually the total of those, because you up, and I'll get to this in a minute, but actually I think it's probably on the next slide, but you can have up to 6 people in an SMSF. So it's very common to have at least yourself and your spouse in your own SMSF. Good. Just some other comments on the whole idea of break even with fees. Do you have a good chance of outperforming your current super if you were to take control of your own investments? And are there other benefits to the SMSF, such as your business premises or making investments that you couldn't do with retail super? So yeah, there's the couple of key things that are there. And I've already touched on this, but but again, I'll say it again. The SM in SMSF means self-managed. It does require diligence to set up and run, and there's compliance requirements as well. So yeah, generally the way we work with clients is we are asking you for the information to make sure all this stuff is sorted. So assuming that and then the other thing is there are rules around what you can invest in as well. So we want to make sure where clients are unsure if they can invest in a certain thing with their SMSF, please reach out just to check that, that what you are looking to put your money into is legit from a superannuation rules perspective. There is an annual audit required by a third party as well. Again, that's something that just we facilitate on behalf of our clients, and it's part of when we prepare the annual reports for an SMSF with all the work papers. The audit involves just sending that to an auditor for them to sign off on and ask any questions if they need to check from a compliance perspective. And just on the audit side of things, they were exploring, this is the government, changing the audit requirement to every 3 years. I haven't heard that being pushed for a little bit. But yeah, the audit is about $400 to $500 depending on the auditor. And yeah, not a huge burden from an annual perspective. Now, in terms of the idea of being a family fund, so you can have up to 6 members in an SMSF, although I just consider maybe that's not the greatest thing to do. We saw from the stats earlier that it's, the statistics show that there's about 2 members per SMSF on average, which would likely be you and your spouse. But in terms of having other family members in your fund, you've got to consider I was taught these things. You got to consider things like death. What happens if someone dies in that fund? How does that play out? What about disability as well? If someone's not able to make decisions on behalf of the value of their fund, and also divorce. So in the example where, let's say, you and your spouse have your child and then their spouse in the fund, and what happens if your children get divorced, or even you and your spouse as well? It can be pretty tricky. A couple of things there. More people is more decision makers as well for where the money's invested into. But we can reduce this risk with what's called a leading member super fund, or SMSF. And that's a special type of deed that we can implement for a client where they might have other people apart from their spouse in the super fund, where they're concerned about the control being spread. And generally without that leading member fund, usually the person with the highest balance has the biggest sway in terms of decision making, if that's anything to go by. But my understanding as well is you can't force someone out of a fund as well, so they've got to elect themselves out. So where you've got, let's say, a son or daughter-in-law who's now an ex-son or daughter-in-law, and you want them out, that can get tricky. So again, the leading member fund, if that's a concern to you, can control who is a member or not. That is a function of that deed. So yeah, and then in terms of the death side of things, how you do your estate planning and how it intertwines with your SMSF is important to consider as well. And if you have a standard SMSF, we can convert that into a leading member down the track as well. Alrighty, next one here is the ability to control tax. So yeah, this is a sort of diagram we show clients to give them an overview of the different types of structures available in Australia. The first one there, I'll use my little pointer here. The first one here is a sole trader or an individual. Our tax rates go up to 47% tax. With the marginal rates, tax planning is pretty crappy when it comes to investing or running a business in your own name. You can't do a lot of things from a tax planning perspective to help reduce your tax bill. And then asset protection is pretty much, this is in the context of running a business. You run a business in your own name and there's literally zero protection against assets held in your own name, because it's essentially you running your business as yourself. Now, if we go to companies, there's two tax rates for a company. Under 50 mil turnover and running a business as a company, you get a 25% tax rate. But if it's an investment only company, you're at 30%. There's a couple of exceptions to that. If you've got a business in the group where you may be able to get an investment company down to that 25% tax rate. But if we think generally, investment is 30%, business under 50 mil is 25%. Better for tax planning and asset protection if it's set up right. And then similarly with a trust, tax planning and asset protection are great. The 0% tax rate is a bit cheeky. What a trust does is it actually gives its profit to other people or entities in the family group, and they pay the tax on behalf of the trust at their own rates. So, if a trust gave it to a company, it'll pay either 30 or 25%. Or a trust gives it to individuals, it'll pay at the marginal tax rate of however much their total taxable income is. Now, if we contrast that to the last one here, SMSFs, SMSFs have two tax rates. We've got a 15% tax rate as we are accumulating our balance over our lifetime. So that's tax deductible contributions that go into your fund or by your employer. Any tax on the income that you earn as you're accumulating your balance as well. So that's the accumulation side. Now, when we're in pension mode, we call it, so we get a 0% tax rate, which is pretty insane. There is conditions and limits to that, but it covers most people. It's $1.9 million is the current limit. So in terms of the assets that you have invested, the first 1.9 mil, you'll pay tax at 0% on its earnings, which is again pretty sensational. If you've got a spouse, obviously we go 1.9 mil times 2 if you've got equal balances, which gives a pretty tasty amount of assets that you'll pay no tax on the earnings of. Alrighty, so there's the tax rates, and as you can see, we don't even need to go to the Cayman Islands to access a 0% tax rate. It's just saved for later in life when we are 60 and retired, or 60 and over. You can still be working. There's no retirement requirement when you're over 65 to get that 0% tax rate. So yeah, it's pretty good. One advantage of getting old. Alrighty. I already explained. Yep, accumulating 15%. Pension is 0%, up to certain limits. And then, yeah, tax-free investment property, but investment profits, but also tax-free capital gains tax. So an SMSF has control over when they sell an asset. And let's say, you're in your 40s and you buy a commercial property for your business, and we're now 62. We've sold the business. We've still got the property. You've retired, and you go and sell that asset that you bought a couple of decades ago, and you've made $2 million in capital gain. That's probably going to be CGT free, based on that 0% tax rate. So again, long-term strategy can be pretty cool when it comes to, accumulating wealth for your family, and then, even timing your capital gains of when you sell an asset. So yeah, it gives some fantastic flexibility. Now, this slide may be very difficult to see. Depends on how big your screen is. What I wanted to do is show the if everyone's heard of the effect of compounding investment earnings. So let's suggest a starting investment of 100 grand, and then you put 10 grand a year in for 50 years at an 8% return. It's going to be worth a huge amount, especially it's almost like this what do you call it, exponential growth by the end of it. What I wanted to show is what's the effect of a lesser tax rate on when you're compounding your investments over time. So the scenario here is that, each of these, like if we've got an investment company, or we've got an accumulation super fund or a pension super fund, and we start with 100 grand in all those scenarios, and then each year we're adding 55K in investment, whether that goes into the bucket company at a 30% tax rate or in super at a 15% contributions tax rate. What I want to show is over 10 years, what does that look like? So again, we start with 100 grand and then we add 55K before tax in each of these scenarios. So the bucket company is where you'll have the least amount net of tax at the end of that because you've got the higher tax rate of 30%. And sorry, this is also modeled on an 8% return. So a bucket company, you'll end up with 670K in that scenario. An accumulation fund where you're not drawing a pension, you end up with 832K, but a pension fund 893. So here's the net benefit of investing in a SMSF in accumulation mode. So 162K versus almost $250,000 in a pension fund where you're paying that 0% tax on the 8% earnings, if that makes sense. So again, if we extrapolate this out over 20 years or 30 years, depending on your investment horizon, it can make a big difference when it comes to your net return at the end of the day. You are also limited to how much you put into super as a tax deduction each year. Currently, the limit is $30,000 per person, per adult. So for you and a spouse, that might look like 60K as a concessional contribution. Now that 30K includes employer contributions and also after tax if you decide to put extra money as a personal contribution as well. The other one where people get unstuck with that is if you do a personal contribution, even business owners where you just flick 10, 20 grand into your fund. If you don't do this is a key point. If you don't do a notice of intention to claim a deduction, it's a form you got to do, send to your super fund so that they receive that and they record your contribution correctly. Then technically you can't get a tax deduction for that. So we need to make sure if you are contributing to super as a personal contribution, that the paperwork is done to support that. Alrighty. What have we got next? Investment strategy. So one of the requirements of an SMSF is to have a documented investment strategy, and that's also kept up to date. So usually, best practice is usually once a year, unless your investments are going to change considerably. For instance, let's say you're invested in managed funds and you want to buy a property. Ideally, your investment strategy is updated to include the ability to invest in property. Things like might have this. Yeah, here we go. Here's the stuff it should include. So the risks of the investment, it should have. It doesn't have to stay within a certain guideline, but your investment strategy should consider how risky an investment is, how diversified it is as well. And it also should include benchmarks. So what that looks like is, let's say you've got, you want a pretty protected fund, and your investment strategy might say, I want 30 to 60% of the assets invested in managed funds, and I don't know, 40 up to 80% at any one time invested in cash. That's the sort of guidelines you have. And again, you want to make sure that your fund is keeping in line with whatever you write in your investment strategy. Otherwise, you just need to change your investment strategy to suit that. Should include the intended return on your investments. It should include borrowings. And if you intend to borrow, for instance, you want to buy a property, making sure that's written into your investment strategy. In particular, where is the fund going to get its cash for the repayments of the borrowings? Things like just generally like, yep, we're going to contribute each year. All the members are going to put some money in and it's going to get rent. That's enough to cover the borrowings, stuff like that. What they want to see is that there's thought gone into how your SMSF is being run. Insurances. So that's another consideration. It doesn't mean you have to have insurance in your fund, but something else to include, and also liquidity and cash flow requirements. For instance, if you're drawing a pension of 50 or 100 grand a year, how is the fund going to, how is the SMSF going to fund the repayments for that? Yep, cool. So investment strategy is not a set and forget thing. It is ideally reviewed each year. In terms of the type of investments that you make sure they're permitted under the trust deed. Now, most trust SMSF deeds, sorry, an SMSF is a type of trust. That's why I'm referring to a trust deed. Now, most deeds will be quite open to what your fund invests into, but it's always good to make sure that whatever specific thing you're looking to invest in is allowable. And the other thing is it's not prohibited investments by the SIS Act. There is certain things you can't invest in with super. Collectibles was something that was popular years ago. I've seen some really random ones, movie posters, cars, things like that. But now collecting, what do you call it? Collectibles are not allowed. And if you did have them, then you had to have put a strategy in place to get rid of them, liquidate the assets there. So yeah, there's an example of something that is excluded. The other one is that it meets the sole purpose test. So essentially what that says is, it's probably on the next slide. Yep. Your fund needs to be maintained for the sole purpose of providing retirement benefits to your members or to their dependents if a member dies before retirement. Now, back in uni or CA or something, some course I did, an example of a breach of this is that a client or an SMSF bought an apartment that was somehow related to a golf course. As part of the apartment purchase, it included a membership for a person to join the golf club, for no extra money. So the member joined the golf club for nothing, but it was a benefit of the SMSF investing in the apartment, and that was a breach of the sole purpose test. So I mean, it's a pretty lame example of that, but a pretty serious one. Actually, I had a client probably. It was pre-Inspire, probably 15 years or so ago. They'd made a lot of money when they were young through a business sale, and they were literally drawing money from their SMSF bank account into their personal account to fund their lifestyle. It added up to be millions of dollars. That is a breach of the sole purpose test. They weren't retired. They didn't meet conditions of release of the money personally. But the client amazingly got away with a bit of a don't do that again from the ATO, and was required to pay back millions of dollars to their own super fund. So basically just make it right. I'm not suggesting that that's something that we should encourage clients to do whenever they're facing cash flow issues, but an example of breaching the sole purpose test. Cool. So the next one is leverage, and that's a fancy way of calling borrowing money from a bank or a third party. An SMSF cannot borrow money to buy property directly. It's got to do this thing called a LRBA, an acronym, Limited Recourse Borrowing Arrangement. And what it does is, instead of the SMSF buying the property directly, we've got to set up this thing called a bare trust. And it sits between the property and the SMSF. It actually is the one on the title, like when you go and on the contract, it will actually say the bare trust's name instead of the SMSF, as a way around borrowing restrictions with SMSFs directly. Basically, it's a lot of paperwork for the SMSF being able to borrow to purchase a property, or you can even purchase certain types of other assets with lending as well. So the other things is that the borrowing can be borrowed from a bank, or it can be your own family's cash. So very commonly, if people have bucket companies or corporate beneficiaries in their structures, we can set up lending, this limited recourse borrowing arrangement between their own bucket company and their SMSF. So that it's pretty cool how it works. So let's say it's a purchase of a business premises. How the cash flow works is the business pays rent into the SMSF bank account, and the SMSF repays the loan to the bucket company, over time now. So you basically got rent going in and coming straight back out to your own other entity, but even contributions. So your 30K tax deductible contributions per year, again, we can still put the cash in and then repay the loan straight back out again. So yeah, we've got clients who use that strategy where they lend their own SMSF money, but there are a couple of lenders in the LRBA space who regularly lend for property purchases, and that can be commercial property. That's very common, especially for business owners, but it also can be residential property as well. Now, in terms of lending outside or inside super, a mortgage broker is the one who can give all the credit advice around this. Uh, but in terms of just some high level comparisons, outside of super is less complex in the sense that it's not LRBA lending. So when you go and buy your own home, for instance, that's not a limited recourse borrowing arrangement. If you're borrowing for an investment, you will have more tax outside of super in pretty much every case because the tax rates are much higher. In terms of servicing the debt, the banks look at business or personal income to service. But if you're looking to own or occupy your own business premises, some of the banks will look at your rent that you're paying to a third party and imagine you're paying that to your own entity to purchase the thing. So they might look at your removing your rental expense, assuming that you're going to move your business into it. But again, that's something to check with the mortgage broker. And the other benefit with borrowing outside of super is that you can use security on other properties generally for a deposit on what you buy outside of super, but you can't do that in an SMSF. With both inside or outside of super, you can own or occupy if it is commercial property. In a super fund, you cannot purchase residential property and live in it. That's a breach that would breach the sole purpose test that we talked about earlier because you're living in a property that's funded by your super fund before retirement. Also, we can see LVRs or loan to value ratios go to 80%. It's quite depending on the suburb and what you're buying. We see SMSF lending go to 80%. You can get higher, of course, outside of super with lenders mortgage insurance, but I haven't seen much above 80% in super or anything really. And then inside of super, so I mentioned we've got that LRBA weird bare trusty thing. We've got super contributions are generally included from the bank servicing perspective, and then also rental income on whatever you're looking to purchase. Tax is lower, tax rates are lower. You've definitely got a limited choice in lenders. So when I got into working with SMSFs, most of the big banks would lend to SMSFs and then a few weird small ones. Now it's primarily two lenders in the space, but there are talks of the big boys like CBA, etc., getting back into this space. I think that was with the bank. What's the bank thing? They've been out of it for quite a few years now because I think there was some banking review years and years ago, and they all got scared of it. But yeah, we definitely had big banks lending as late as 2017 and 2018, around that time. We're still seeing like CBA on contracts. The interest rates are typically higher in SMSF, but they're not ridiculous. So we've seen rates around the 7%-ish. I'm unsure if they're as low as 6%, but even it's hard to get 6% on investment debt outside of super either. So yeah, they're not crazy. I'm pretty sure they used to be higher, like by 3 or 4%, noticeably different. But yeah, I think there's definitely more competition. Also, the other frustration that clients might experience with this process is that the lender can require legal advice, and what that looks like is bank trying to push risk on the client and or their advisors. So they might want your lawyer to walk you through the documents and tell you how risky it is, and then sign off something to say that they've told you how risky it is and charge you $1,000 or $2,000 for the process. The financial planning requirement, I've seen less and less of because financial planners will barely want to touch this stuff because of the perceived risk involved and all the financial planning drama that's happened over the last sort of 5 or 10 years. But there was a time where banks would force clients to go and get financial advice, which again looked like the financial planner saying, here's your risks, here's what it'll end up looking like, paying your loan back over time. Yes, we think it's okay, or no, we don't. And then the client can still override that anyway. But it's again, for the bank to, as part of their risk mitigation thing, is to go and get the client to do these other things to be aware of the risks involved. Um, Inside of super, yeah, I said in the outside of super, you can generally use the equity you've got in other properties to borrow. Inside of super, there's a slide. Inside of super, you need a cash deposit, usually 20% plus all your closing costs like stamp duty, legal fees. But some banks have required a leftover amount. I haven't seen it for a little while, but there was a time where 10% of the value of your property needed to be left over after the transaction, to pay rates, to pay, the ongoing expenses. So they had a liquidity requirement. So in that case, you had your deposit of 20%, let's say, plus 5% for stamp duty and all the other crap, and then another 10% of the value of the property for liquid cash after the transaction goes through. So yeah, again, you got to plan out your cash requirements for that. And then the last one there is you cannot borrow for construction costs unless it's off the plan. So what we can't do with super is have a house and land package where you've got a contract with the land developer and a contract with the builder that's separate. You can't fund that construction contract, but you can. This is all the rules around this. But let's say you purchased there's one around the corner. The builder is the developer on this house and land thing around the corner. You'll receive a single contract, and that is okay for whatever it is. The rule the SMSF is breaching if you've got two contracts is the requirement where you borrow money with the super fund. It's got to be for a single acquirable asset, and a house and the house separately and the land is two separate things. As dumb as that is, you can get the same outcome if it's a single contract. That also was an issue with apartments and their related car parks. There were some states where your apartment contract is separate to a car park related to that apartment contract. And that was a big no-no with this rule around lending. So what they do now is they sell you the apartment and you've got a license to use whatever car park is related included in that contract. So that's how they get around that issue there. So yeah, you got to be careful. And then there's also a requirement where you can't use borrow money to change the nature of the asset either. So what we can't do is buy a house and land that's existing and then develop it. So knock it down and rebuild the asset with borrowed money, because that changes the nature of the asset itself. So yeah, there's a few rules around lending. Again, if we've got property clients who do lots of property development with their super funds, but it won't be any of those things that breach the rules like that. There's generally other structures we explore for property development where there's borrowed money required that are easy. We don't have all this, limitations like the directly held property I'm speaking to right now. Alrighty, I've already talked about deposit required and the liquidity of 10%. This is not credit advice. The mortgage broker is the one who's licensed to give you the specific advice around this stuff. Just make sure they've done SMSF lending, because there's some who don't. There's some who will glaze over when you mention SMSFs. So yeah, it's not a terribly complex thing to do for the mortgage broker. In fact, the forms to fill out for SMSF borrowing are actually less than all the stuff you need to do for home loans, for instance, like just general lending. But it is something you want to talk with someone experienced about. Alrighty, switching over to insurances. So yeah, you can hold different types of insurances in super. Some you can tax deduct, some you can't. And then also there's implications of, holding it in super versus outside. So some of the pros is you pay the premium from super. And if it's a tax deductible premium, it's tax effective because, for instance, life insurance, you can't deduct outside of super. The downside is it reduces your super balance, of course. And the other con is, let's say it's an income protection policy and the super fund's paying for it. The payment will be made to the policy holder, for instance, the super fund itself. So, and you might have had some accident or injury that prevents you from working and the insurer pays you out. But if it pays to your super fund, there's different rules required to release it from super. So you've got to be pretty banged up to actually get it out of super itself. So I think you've got to be pretty permanently disabled for that. So yeah, sorry, I'll go back a slide because that's a different topic. Just on that, again, this is financial advisor territory where they're an insurance. They can advise around insurance, but I know I've got a split policy. So some of the money I pay comes from super, and some comes from outside of super. And income protection is one that will actually pay to me personally, so it skips my super fund. Um, so there are policies where they know this stuff, and they'll try to get the best of both worlds in terms of how you pay your premium and then where it pays to if you ever have a claim. Incapacity planning. Um, all right. So this is where, again, you're in pretty poor form if you can't make financial decisions. You've lost capacity, whether permanently or temporarily. So the encouragement is to have an enduring power of attorney in place to be basically allocating a person to make decisions on your behalf. They can step in and manage your superannuation or SMSF compliance and that sort of stuff on your behalf. And again, even a good thing to have for spouses to have in place. Now, this is usually what we set up when we help a client with estate planning, where we do wills, testamentary trusts, but also the acronym is EPOA, Enduring Power of Attorney, to make sure that if one of the spouses was to become a bit unstuck, the other one can step in and assist. Also good for even if you're overseas, and let's say you're selling a property, you need someone local to sign. It's common to have your solicitor appointed, for only a certain term or a certain set of things. Yeah, I mean, there's many uses for this sort of stuff. Um, Oh, yeah. So the super fund requires all members of the fund to be trustees or directors of the trustee company. But there is a way to basically delegate that directorship responsibility to someone else where someone has an EPOA, basically the other director having the say for that member. So, um, yeah, long-winded way to say if you've got two people in your SMSF, generally they both need to be directors unless you've got this thing in place where one can be appointed on behalf of the other. And yeah, you need to understand what happens with incapacity or death, which I think is the next topic, in your trust deed. So what happens in the event of incapacity? Switching gears, so you're not just incapacitated and you're now dead. What happens then? Estate planning in general is not just a will. It's not just having that piece of paper, the will involved, because a will generally just covers assets in your own name. Now, when we're business owners and our intention is to have as little assets in our personal name as possible, the will is often the least useful piece of paper in terms of our estate planning. Superannuation, the topic we're talking about is SMSF. So superannuation proceeds after passing is dealt generally by binding death benefit nominations, or the acronym BDBN. I'm going to be careful there. But we put that thing in place to basically bind the trustees of the fund or whoever steps in once you're gone, to be able to follow your instructions to pay out your superannuation balance. Otherwise, it's dealt with by the trustee, and that may not be a great idea depending on your circumstances and depending on if your estate is likely to be contested by kids or ex-spouses or whatever. Cool. So yeah, your superannuation can be paid to your estate to be dealt with under your will, but it's not guaranteed. So, and again, if you put a binding death benefit nomination to go directly to your spouse or directly to your kids, you can actually skip your estate, and skipping your estate means you reduce the amount of assets that are at risk of being contested. And all that contesting stuff is generally that the lawyers will fight with each other and dwindle away your estate because the fees come from the estate itself, the legal fees. So there's generally no downside in someone having a crack at the at contesting. The other thing that I hear some clients say is, oh, I don't need to do estate planning. I've got the business, which might not be worth too much. And I've got the house, but it's jointly owned. It's probably a no-no, but it'll just go to my spouse. I don't have much assets, but if you've got life insurance and it goes to super fund, let's say you've got a couple of $1 million in life insurance, there's a $2 million asset that should be dealt with wisely from an estate planning perspective. So even though you don't have assets now, if you die and your insurance policy creates assets, again, we need to be careful that we deal with this stuff. Alrighty, I've got 6 minutes left and a few case studies to go through. If you've got questions, make a note of them or pop them in the chat box. But we will have hopefully some time for Q&A. But we'll fire through some case studies. The first one is the vet from the bush. He had his commercial premises outside of super in his own name, big no-no for a few reasons. It was worth 300 grand and he had the type of debt it was like a 5-year recurring loan, really weird thing. And the 5 years was about to come up and he had about half of the value of it owing, about 150K. He actually sold his property into his own SMSF. Paid stamp duty on that transaction. And we also needed to consider what capital gains tax looked like for him personally. Even though you're selling to a related party, your own super fund, we still need to consider this thanks to our tax rules. His SMSF he set up with, it had about just over 100 grand. So it was able to pay out the loan without borrowing money itself from a bank. But he lent the remaining money that was required through a vendor finance loan agreement. So he basically self-funded the SMSF from his own equity. And what that looked like, again, we talked about this earlier, his business would pay rent into the SMSF as a tax deduction, and then the money would then be paid out for repayments on the loan he lent himself, and his 30K per year contributions, they go in, set aside 15% tax, and then repay the loan. Now, obviously, there'll be a time over the next few years where his loan balance will be zero. But again, that's how we can sort of recycle some cash from outside of super in for related expenses or contributions and back out for loan repayments without needing a bank. I think I just described all of that without the words. Another one was we had a client double their super fund, pretty much tax-free. So they had a commercial property owned outside of super. It was worth about $1 million. The client was shifting into retirement, wanted to move assets into super. That property was one of them. He had 300 grand as a deposit in his SMSF, 700 grand loan from the bank. He didn't own or occupy this property. It was just a commercial property he had as an investment. But for a few years in the SMSF, he was receiving rent now with 0% tax. A few years later, he got an offer from someone else to buy the property for 1.3 mil. So the SMSF bought it at 1, sold it at 1.3, and he made a few hundred grand tax-free because of that 0% tax rate. So pretty cool. And then again, the effect of that meant he started with ballpark 300 grand in super in his SMSF, and a few years later he had 600 grand. So there's the old double in 3 years strategy. IT business in Melbourne. That was a client who grew quite rapidly over COVID. He had an opportunity to buy a property near his home, like one of the almost like the warehousey shed, not sheds, but where there's like a ground floor and you can put a little mezzanine at the top. Purchase price was 300 grand. It needed a fit out, which was funded through prepaid rent. Okay, so he didn't have enough in super to do the fit out and buy the property from, he needed money from the bank. But he was able to prepay rent from his business. I think it was about 12 months of rent he prepaid, which was enough cash to do the fit out. The fittings and furniture were paid by the business itself because there's better depreciation that way for the business, better tax outcome. And the client is now paying a similar rent to what they were paying previously, but it's to his own SMSF, and he's got an asset that's building as well. Um, Conscious of time, punching through these. Had another client who there's four business partners again in Melbourne. They're buying a property. They all had SMSFs and they all had about 200K to chuck towards this. They purchased something for 750K, so they didn't have to borrow a thing. We used what's called an ungeared unit trust because there was no borrowing. Each partner owns 25% of the units in a trust, and that trust owns the property outright. So again, the profit from the rental income goes to each of their super funds, and it's taxed at 15% or 0%, depending on their circumstances. And I think this is the last one. So we had a construction um, industry client where they had a home office, but again, one of the businesses that grew in COVID. The home office was hitting its limits, and they had a baby on its way, and they didn't really want team to walk through the house out the back to the office out the back. The client purchased a property close by, 800 grand, and around 75% money coming from the bank. It needed renovations, but they did have enough cash in the fund to put solar on the roof, lick of paint, a couple of partition walls up. The furniture was paid for by the business. We had the instant asset write-off once upon a time. That was a high limit. And then the client now has a lovely shop front. They've actually got a second tenancy beside as well because they didn't need the whole property. Yeah, it's increased the valuation through the renovation. They're on a pretty decent street. Not in the city, but in the suburbs. And yeah, they bought this probably partway through where the property prices really went skywards. So he's done all right. Cool. So we're right on midday. Happy to take some questions though. And if you do want to explore, if you're not working with us and you want to explore what it looks like, or you got some further questions around SMSFs, book a strategy call with one of our accounting team. We can have a chat. Thanks, Michelle. Otherwise, let's jump into questions if there are any. Michelle's mentioned that his was answered. That was one that was in earlier. Could we use the money in super to buy a percent of a commercial property? Absolutely, yeah. No loan. Yep. The other one there, Michelle, is that you can actually, if you've got some money inside of super and some outside of super, there's a certain type of structure where you can have a percent owned. You've got to use ungeared though. There's no lending. You can, let's say you own 25% of the property inside of super and 75% outside of super. That's possible as well. And what I usually say is that tell me what outcome you want with the property. Like what do you want to buy and why, and then we'll work out the rough like different options for structuring that, and there might be two or three different options, and we pick the one that suits you the best. Also, where you've got business partners, your options increase because there's additional structures available where you've got other families involved as well. Thanks, Daniel. Yeah, I'll chat this afternoon. Kevin Pascoe, rough annual admin fees for an SMSF. Again, keeping in mind it's different depending on if you're in accumulation or pension or what investment types you're invested in. Commercial property, you'll need BASs done. Crypto can be a bit intense depending on how you send us your reports. So there is definitely. Thanks, Michelle. See you, mate. There is definitely some consideration to what you invest in, but ballpark accumulation is usually about 3 grand or so a year. And then you're looking at about 4K for a pension fund. They're ballparks. But yeah, and that includes the software subscription. There's a requirement to have a electronic service address now with the ATO. Basically, it sends information to our software. That's a requirement. And then all the reporting and compliance and accounting, tax returns, all that sort of crap that you have to do. And then the audit will be another consideration. So I think our audit charges about $400 per audit a year. And we haven't had one. I think they call it qualified if it's bad. I don't think we've had one ever. So it's pretty cool for them to sail through. But generally, we don't have naughty clients. Oh dear. Hope that helps, Kevin. Um, was the four business owners an example? Yeah, the four business owners, Michelle, I think he's gone though, but that's an example of an ungeared unit trust. And you can own inside or outside in a percent of both. All right. Thanks, Brad. Good to see you. Steve, I didn't see you there. Ah, had to click the arrow. Keep moving across. All right. Well, there you go. I was wondering where you were. Uh, all righty. Well, if there's no other questions, we might wrap up there, but I hope that was helpful. Thanks again for everyone for tuning in, and we will talk soon. See you at the next workshop. Garth, didn't realize you can lend money into the SMSF and have it pay back. Absolutely. Yeah. Got to get the right paperwork in place, but yeah, we've done that a few times. Peter, thanks. I missed the start. Yes, we'll send out recording usually same day. Should be here at Sabo. All righty. Thanks again, everyone. All
Awesome.
right.
Thanks, Ben.
Thanks, Lizette. Cheers. Thanks, Cliff. All righty. Bye-bye.